Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, November 7th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. So let's hop right in. So today's key macro question is the U.S. government shutdown exacerbating the Powell Fed's policy mistake? The short answer is yes. In terms of the analytical nuance, the decline in equities today is truncating the S&P 500's three-week winning streak. Losses in cryptocurrencies are deepening amid a steep sell-off that left digital assets nearly flat for 2025. This is after EPFR data indicating U.S. equity funds posted an eighth straight week of inflows, the year's longest streak. The upside capitulation that we called for back in early May appears to have concluded and left the positioning cycle in a dangerous place. Per our November 4th leadoff morning note. To the latter point, our positioning model indicates there is high risk of a crash in risk assets over the medium to long term, as evidenced by the quantity of stable indicators in the model breaching their respective bull market peak thresholds. Perhaps most concerning is the fact that these indicators are currently as lopsidedly bullish as they have ever been on a median basis at historical bull market peaks, with the exception of the July 1998 peak. The Powell Fed clearly does not understand the role the institution must play in this foreturning or to address the K-shaped economy crisis, and markets may punish them for that and us over the next few weeks. We currently anticipate the price will be manageable within the context of our Paradigm C theme, but we could be wrong about that. Stay tuned. Elsewhere, U.S. airlines have started canceling select flights nationwide as staffing shortages from the government shutdown disrupt air travel operations. The U.S. Transportation Department and the Federal Aviation Administration ordered carriers to trim 10% of flight capacity across 40 major airports to ease systemic strain. The forced reductions in airline travel lend further support to our U-shaped economy thesis, which affords the Fed a clear and obvious window in which to continue normalizing monetary policy. Our criticism of the Powell Fed's many policy mistakes has been well documented and well received by both investors and the general public, so we won't beat that deceased equine again. Rather, we turn our attention to our friend, BlackRock executive Rick Rieder, who is on Treasury Secretary Scott Bessent's short list of potential successors to Chair Jerome Powell. Like Secretary Bessent, I've known Rick for many years and consider him to be at the very top of global Wall Street from both a capability and compassion perspective, two skills that will be required to persuade his potential colleagues on the FOMC to ditch their failed, backward-looking reaction function and get on board with ending the three-year recession for the consumers and small businesses gasping for economic oxygen at the bottom of the U.S.'s K-shaped economy. Rick's latest commentary mirrored our own long-standing data-driven critique of the historically tardy Powell Fed in stating that the labor market is weakening and that the policy rate should decline to 3%. We have a softening in the labor market that is quite significant, Rieder said on Bloomberg today. If we had the jobs report number today, I think that would be reflective thereof. Secretary Bessent, Scott, if you're listening, Team 42 cannot endorse Rick enough for the fourth turning size job of implementing structural regime change at the Fed. Much needed structural regime change at the Fed. This institution, with its myriad, hundreds of econ PhDs, continues to fail the American public. And again, this is not a tirade against econ PhDs. I have a tremendous amount of respect for anybody that can attain a doctorate in economics. It's very hard. I remember the first class I took at Yale, I walked into my microeconomics course and literally I thought I was reading Chinese, and I walked out of the course early. I called my mom and I said, "Mom, I'm not sure I'm going to be here for very long." I read this true story. So clearly these people are obviously incredibly bright. They're brilliant. This is, again, not a pejorative attack on econ PhDs, but what it is, it's an attack on their hubris, and it's an attack on their illusion of validity. It's an attack on their ability to think that they know all the answers when, in fact, they should be demonstrating a far more humility and have a much more open mind about how to address some of these issues that we continue to see in the economy and asset markets. I mean, half the economy, if not more, from a sectoral and household perspective and business perspective, has been in a recession for almost 3+ years now. And they have no idea. The labor market is very clearly unraveling no matter where you turn. Obviously, they've got the challenger job cuts data, the sharpest decline in challenger job cuts in the month of October since 2003. You know, again, I'm just cherry picking that data point, but there's been so many other data points going back to the data points that I cited in the op-ed that I wrote in late July. And so for the Powell Fed to be pushing back against further normalization of their allegedly restrictive policy, which they continue to confirm is restrictive, is ironic and noteworthy in my opinion, especially given the context of the stress that is building on a trend basis in the repo market. No matter what direction you turn, there's all sorts of signals from both the economy and financial markets that are telling the Fed that they are falling further behind the curve as it relates to their monetary policy and their balance sheet policy. And so I don't understand what the holdup is. I hope it's not political. I really do hope it's not political. But again, don't forget, this is a Federal Reserve that may not want to, create the conditions for a paradigm C economic boom ahead of the midterms next year. That's definitely a risk. And so I don't know. I don't know. I don't know if it's political. I don't know if it's hubris, but it's definitely something. With the hundreds of econ PhDs operating that institution, I think they just need to demonstrate a far more open-mindedness and humility about the legacy of policy mistakes, which we talked about in last Friday's Macro Minute, which are, it's a very long list of very hazardous policy mistakes that have left a significant scarring in and across the U.S. economy. So, as always, members of our global investor community can trust that our institutional grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This was titled Supreme Court Tariff Ruling. Darius, after reading the posturing of both conservative and liberal judges on the Supreme Court towards Trump's attorney, I'm almost certain that they are going to rule against him on his ability to implement the tariffs under the Emergency Powers Act, something I agree with. The decision is expected sometime between December and June of 2026. How would you expect this to impact the markets? I'm actually supportive of Trump's use of tariffs to attempt to equalize the trade imbalances, but I recognize the pattern of questioning by the justices, and I'm willing to bet that on their decision to rule against him. Just very curious to know your thoughts on the ramifications if indeed it plays out that way. So a few things I'll say about this. Number one, earmuffs. If you hear the word tariffs, I've been telling you guys that since May. Early May 3rd to be exact. If you hear the word tariffs, put on earmuffs because the media is going to overplay this because it is negative, and the media gets paid to sell you negativity because it moves ad product faster than positivity. This is not an attack on the financial media. This is literally 100% of all forms of media. 100% of all forms of media, be it social, TV, print, they all make money by selling advertising. And selling negative stories sells more advertising and generates more revenue for their businesses, media businesses, than selling positive stuff. So it's been my job as a macro risk manager all year to focus our global investor community on the positive stuff. If you think about the Trump economic agenda, it's a four-legged stool. Besson said it was a three-legged stool, but in my opinion, it's a four-legged stool. On one side of the ledger, the negative one, the tariff one that keeps making news because everyone's so focused on the orange man and his Truth Social account, that's the one that everyone's been focused on that's caused him to dramatically underperform both the markets and KISS and Dr. Mo all year because they've been hyper-focused on the one negative leg of the stool. The other three legs of the stool are resoundingly bullish. You have fiscal easing, you have deregulation, and you have likely structural regime change at the Fed that'll lead to monetary easing. We could be wrong about the latter, but the reality is on a net basis, fiscal easing plus substantial deregulation plus monetary easing is going to dramatically overwhelm the tariff, the negative part of the economic agenda, because trade and the goods sector are not big parts of the U.S. economy, which is something I've been saying all year. So we obviously nailed that more than anybody. Like I said, I continue to say there hasn't been a person or firm on global Wall Street that's been more right about macroeconomic and financial market risks than we have in 2025. And I will put our track record since we started this firm in April 2021 against any investor in the world. Maybe someone taking, with someone to have some super high beta crypto exposure that's blown up 2 or 3 times since then may have better returns, but on a risk adjusted basis and in terms of calling financial markets, I don't think anybody's been better than 42 Macro since we started this firm in April of 2021. So getting back into this Supreme Court tariff ruling. So another thing I'll say about this is even if they rule against them, it doesn't matter. They have other authorities that they can use to levy tariffs. Section 301 tariffs, which are targeted to countries, individual countries. Section 232 tariffs, which are targeted to the sectoral tariffs. They can recreate this entire process. It'll be slower, and it'll be it'll require some these sort of administrative review processes where they have to survey the public and get public commentary on their plans. But the reality is, it's not going to stop them. The orange man campaigned on tariffs. He's going to implement tariffs. Move on. Earmuffs. So with that, we will wrap it up. Darius Dell here, presenting our macro minute for Friday, November 7th, 2025. Today's supposed to be the jobs report Friday, but the grifters, the grandstanders, the crybabies, and the finger pointers in DC continue to have our government shut down. So we obviously didn't get the jobs report today, but we here at 42 Macro are hard at work still, and so we're going to be publishing our November macro scouting report to our global investor community this afternoon. So stay tuned for that, because that's going to be action packed with what we continue to observe as some of the best macro risk management content on global Wall Street. So wrap it up there. Everyone have a wonderful weekend. We'll catch you back on Monday. Cheers.